Today we have a very special guest on the channel, Adrian from Passive Income Investing. And if you haven't watched Adrian's videos on YouTube, I want you to go do that. We put a link below to his channel. But today we do an interview with Adrian and talk about what is passive income investing, how he's built a bit of a following on YouTube, and also a really big following of investors across Canada and across the world. And we've dealt with a lot of clients building out a financial plan that do the passive investing and follow Adrian's advice. So very excited to have Adrian on the channel today. It's been a long time coming, and we will definitely do more of these videos going forward. So if you enjoy this type of content, make sure to like it, put a comment below on more questions you'd like us to ask Adrian in the next interview we do with him. So welcome to the channel, Adrian. So Adrian, thanks so much for joining us today. Just to start, tell us a bit about yourself and how you got going on kind of passive investing, and a bit about your YouTube channel that you have going there.
Sure. Thanks, Adam. A pleasure to be there on your channel and Parallel Wealth. Really good channel. So yeah, about myself, I'm just a regular guy. I have no financial background. My background's actually in technology. So I've worked in the technology field my whole career until 2021. But I got started in investing back in about 2012. And when I started, I did what most people do, just stock pick random stocks, the ones that are in the news lately. So, I started with things like BlackBerry and Air Canada, which is funny because I worked for them later on, Bombardier, and maybe some energy stocks. So it really started just for fun. And we really started getting into, the style I do now, or the income investing style, in about 2018. So during that time, 2012 to 2018, mostly just investing for fun, random stocks, started liking dividend stocks a lot. We actually focused most of our disposable income, everyone knows this story, on paying down the mortgage. So our mortgage, our 20-year mortgage was done in 7 years in 2018. So, we had all this disposable income. So we're like, okay, what do we do with this, all this disposable income? So we did fall in love with dividend stocks, but the problem with single dividend stocks, in my experience, is the high yield ones, the ones that give 6, 7, 8% yield. Typically, they're smaller to mid-sized companies, and they're going to be the first ones to cut or suspend dividends. I've had plenty of experience that way. I could think of a bunch of companies right off my head: Vermilion Energy, Crescent Point Energy, Bombardier had cut their dividend. Aimia, the company I worked for, eliminated it. Chorus Entertainment. So I said that's when the real research and the hunt for sustainable yield was on. Right. So how can I get that 7, 8+% yield with safety while being invested in good quality stocks? So that's when I discovered all these great covered call ETF options out there, which have great stocks, but use income enhancing strategies, that is covered calls. Some of them now have leverage to really boost your yield. So you get a really safe and really consistent stream of income without taking more risk. You actually lower your risk whenever you put covered calls to something. So there's a lot of different funds out there. There's covered call ETFs, leveraged ones. There's even split share funds, which are closed end funds that are really typically income oriented. So that's what my style is, basically income oriented investing. That's what my channel is all about. The channel started, again, just kind of like a side project to show people how I invest. And the income investing style is definitely the best style for me, but I will never claim that it is the best investing style. Everyone really has to choose their own.
Oh, for sure. And is 2018, and you may not know, is that kind of when these funds kind of came out and became popular, or is it because they haven't been around for? I mean, I've been in business almost 20 years, and I feel like it kind of 2017, 18, 19 is when these ETFs, and I mean, more coming out every day, it seems like, around this kind of passive high yield investing approach.
Yeah, so they covered call ETFs started coming out, all pretty much the original ones, in 2011. So they all started coming out after the financial crisis, because during that time, interest rates were cut so low to nothing. Yield was very, very hard to get. You couldn't get anything at, you can't get 5% GICs like you could get now. High yield bonds, corporate bonds, government bonds, I'll give you nothing. That's what happens when interest rates get cut. So they created these covered call ETFs, a lot of them in Canada, during that time, to really provide investors to fill that yield need, right? So that's when they started coming out. And these types of investments, or anything that's income oriented that has covered calls, typically do better or outperform the market in general during the bad times. During a flatter down market. So after 2008, we had this big bull run until 2020, until COVID. So until then, there wasn't many more created because, everyone just growth, passive index, everyone's flying,
Yeah.
10-year bull run. But these types of products get really more popular during the bad times. So in 2020, 2021, 2022, a lot of new ones came out. Leveraged ones, split share funds have been around, some of them since early 2000s, mid 2000s, but more the ETFs that are more popular with investors now. And a lot of new ones have come out in the last, 12 to 24 months. It's pretty insane, but it doesn't really surprise me because this style of investing always gets more attention or more popular during the bad times because everyone wants a bit of yield and safety, and these funds tend to do better during the bad times.
Yeah, which ties me into my next question is like, I talk a lot about on this channel, like personally, I invest in a lot of dividend paying companies. So like blue chip dividend paying, I like it because typically they're, they just plug wrong. They're like dinosaurs, right? Johnson Johnson, Microsoft, Canadian banks,
I love them too.
Stuff. Yeah, they're great. Yeah. Now, I know you have that, but in a different mold. So how does kind of the high yield work? And you touched on it a little bit with covered calls and stuff, but maybe explain that a bit further on like, okay, what's the difference, Adam, between, a blue chip dividend stock versus like this high yield, more passive investing, kind of focusing on the higher yield?
Yeah. They're actually more similar than most people think. And I like how you said it's a different mold of dividend stock. So typically these covered call ETFs, they're just like regular ETFs. They typically hold actually those big blue chip dividend paying stocks, but they just add covered calls on top of that. So you have the income or the yield, which could be, 7, 8, 9% plus. There's always two components to that. There's still the dividends from those great companies, those dinosaurs, like you said, that we all love, but they also add covered calls. So to understand what those are, the easiest way to explain it is there's a stock market where stocks are traded. There's also an options market where options on those stocks are traded. Completely different market. In Canada, it's in Montreal, my hometown. In the US, it's in Chicago, compared to New York or Toronto, where the stock market is. So these are options on stock, and call options, they're buy options. And, covered call strategies have been around for a really, really, really long time. It's actually one of the most basic, boring, vanilla option strategies out there, which just allows you to squeeze a little bit more income from stocks that you love owning. So these covered call ETFs typically are just like blue chip dividend ETFs, like a VDY, right? Where it's the Vanguard or a ZDV from BMO and, CDZ from iShares. The only difference is, you have those stocks, you own those stocks, but the fund manager is writing covered calls on a portion of the portfolio, which gives you high yield. And it's typically, the dividend yields in Canada are typically 4%, something like that. So if you add covered calls, you could easily get to 6, 7 or more. Okay. So what that means is you're getting more income from your portfolio. You're lowering your risk. You're lowering your volatility. Whenever you add covered calls, that actually lowers your risk, but you are giving up some potential upside or share price growth, especially during a bull market. So during bull markets is typically when these ETFs underperform their equivalent without the covered calls, right? So a VDI would do better than a blue chip dividend stock portfolio with covered calls during a bull market. But if the markets are going down or they're flat, typically the covered call one will do better. So it's just a way to get a little bit more defense from your portfolio, and they're geared more for people who really want a little bit more income, consistent income.
Yeah. And of course, my focus is retirement planning, but my understanding of covered call, the way they do it in these funds, basically, if you buy a share at say $100, you're going to sell a covered call to, if it hits 105, you have to sell it to the holder of that covered call at 105, but they're going to pay you a premium to buy that off you. So that's where you miss the upside is if it is 105, 10, you're selling it at 105 and missing upside from there. But if it stays flat, goes down, or goes up just a little, you're collecting that premium. Eventually that expires and you keep the premium, and that's the added yield, correct?
Exactly. So this is why this strategy works really well during a down market, a flat market, or a slightly bullish market. So what you just said there is an example of an out of the money call option, right? If the stock is 100, you're writing the call option at 105. And of course I'm saying you're writing it, but you're not doing anything. This is all the fund manager that's doing it. It's completely passive, just like a dividend ETF. That's an out of the money call. So if the stock from 100 goes to 101, 102, 103, 104, 104.99, the call is not going to be exercised unless it's 105, right? So you get to fully participate in that stock going up, you get to keep that extra premium. So that's a really good scenario for a covered call ETF. But if the stock goes to 106, 107, you have to sell it at 105. So you still made a profit because you have it at 100, you sell it at 105. But if it goes to 106, you lose that dollar upside there, but you get to keep that premium.
Hence why, like a lot of your viewers and people that are involved in passive income, I assume it's more income versus like total return.
Yes. The income is definitely the bigger priority. Over total return in general. And I'm not saying, a lot of these ETFs, especially the leveraged ones, which if you put leverage on something, it enhances everything, the return, the yield and everything. And if you're putting leverage on quality stuff for the long term, so a lot of these leveraged products that do covered calls, they actually outperform the market. But the ones that are not leveraged, for example, just a vanilla basic, covered call ETF, over time, they typically underperform the equivalent without the covered calls or the market in general. One thing to remember is since these products have really all started coming out in 2011, and 2011 to 2020, all bull run, right? It's only normal that the data is underperformance. But if the next 10 years, the market doesn't go as crazy a bull run, or it's a little bit more flat or a little bit more choppy, you're going to see that total return, that performance to start catching up to the index funds, for example. But I mean, there is, these ETFs typically have higher fees as well, because there's more work that goes into, writing the calls. So that puts pressure on the total returns, of course. But these are not total return type of products. They're more income oriented products.
For sure. And it goes back to what we talked about on your channel there. It's like, if you're in the passive investing, it's all about, okay, the income that it produces, meets my lifestyle need. And that's where the kind of the tax planning and financial plan has to come into the picture at some point as well. So,
and the income is very, sorry to interrupt you there. A thing I forgot to mention, it's very tax efficient income as well. So the option premiums is considered capital gains, not interest income or eligible dividends. So if you're in a high tax bracket, over 100K in most provinces, capital gains is actually better than eligible dividends. If you're in a lower tax bracket, typically eligible dividends is better. Of course, I'm talking about the non-registered account because TFSA RSP doesn't really matter. But it's very tax efficient income because it's not interest, which is what GICs give you and corporate bonds and fixed income gives you. It's capital gains income. Most people think, capital gains is just buying low, selling high, and then you make a capital gain. There's also capital gains income.
And so I assume most of these, like there's a multitude of ETFs that you would invest in and you've talked about on your channel. They all pay different types of income. So I guess, is there when we talk to clients about like retirement strategy and tax plan and all this, we say like there's certain things you want to own in your ETF, say non-reg and RSP. Like if you have bonds, own that in your RSP, not in your non-reg account. So there's kind of a structure. I assume it's similar on the passive investing side as well.
It's the same thing.
It's
the same thing. So like I said, a lot of the income is going to be capital gains and return of capital, which is, I put it under the same umbrella as capital gains. It's like delayed capital gains. But, if it's a portfolio of dividend blue chip Canadian companies, you're going to have some eligible dividends. It's inevitable. So you have a portion of eligible dividends, a portion of capital gains. And you could go on the fund's website and see the history of all the breakdown of the income sources. So all that information, I get the question all the time. All the information is there. So especially if you're trying to build out a non-registered account, typically people like in a lower tax bracket, more eligible dividends, and a higher tax bracket, you really want those capital gains. And I typically advise, or, it makes more sense that you have the US focused one, which you'll get more forward income to have that in your TFSA.
Yeah, it's good to know about the risk, because I think a lot of people look at this stuff and say, oh, it's got cover calls, like that sounds risky. And that's where people have to kind of dive in. Okay, how does a cover call work? And what is added risk in there?
Because that actually lowers your risk.
Which is crazy. So it's like, we'll give you more income and lower your risk. Total growth versus income. You got to find, is it a piece of your portfolio? Is it all of it? Doesn't matter. But I think the purpose of this video and bringing you on here is to educate our viewers on like, this is a type of investment. I never like to push one, again, I'm dividend growth, but I never like to push one type of investment, because a different type is, we have clients come in with literally millions of dollars in Tesla stock only. And I saw that that there's a new ETF? I think it's like a covered call ETF with Tesla or something like that came out.
Yeah, Purpose just came out with a bunch of yield share ETFs. So what these ETFs do is they invest in single companies. So the Tesla one is definitely the most popular one right now. They have five of them. There's a Google one, an Amazon one, Apple, Berkshire, and there's a Tesla one. And I think they're coming out with more. Hopefully a Facebook one. I mean, I'm not sure why they didn't come up with that one, but
could have made a lot of money in the last few days. Yeah.
Yes. So what they do is, so this is a special case where there's also leverage involved. So leverage could be a third component of your yield. So there's a dividend, there's the covered call income, and then there's leverage. Of course, Tesla does not have a dividend, right? Mm-hmm. So this is a great way. If you want to own Tesla, you like Tesla as a stock, you're bullish on it, but you're maybe a little bit of a pessimist on it and you want income more than growth, well, this is a perfect way to do it. So what these guys do is the whole ETF is just Tesla shares. They put 25% leverage on it, which makes it 25% more volatile, up or down. But they write covered calls on 50% of the portfolio.
Oh, okay.
So half of that portfolio, basically on Tesla shares, they write covered calls, which generates a lot of premiums, because the more volatile a stock is, especially like a Tesla, the more the option premiums are expensive. So that's why this ETF currently has like 17-18% yield. That leverage also boosts it, right? But this is, it's what I would consider a more risky income-oriented ETF, because you're still investing only in Tesla. It's not like an ETF that has 30 dividend stocks, right?
Tesla on steroids, which Tesla on itself is just volatile in itself. So
it's kind of, there's that 25% leverage. But my opinion, I see this as a less risky way to own Tesla, because whether Tesla goes up and down every month, at least you're making some income. Right? Every month. Now it could. The dividend is probably not going to be set in stone. All two of them came out, they're the same dividend or distribution, I should say. But at least I call it like a plan B or a safety net. Yeah. Because if you just invest in Tesla, there's no dividend. So you're at the mercy of the stock price. Yeah. Right. And then you have to sell it. But this is, you could buy it, you could hold it long term. It'll go up and down. It'll pretty much follow what Tesla stock does to a certain extent, but at least you're getting paid every month. So you have that little safety net in income. Yeah.
It's like they've turned a growth stock into an income stock.
Pretty much. Exactly.
Yeah. Interesting.
Exactly.
Yeah. Nice. So how would someone get started? And I want to kind of jump into a kind of something that just popped into my head. So we're coming up RSP deadline. I need to make my RSP contribution. And so someone that has never kind of jumped into the passive investing stuff, I thought, hey, it'd be fun to take my RSP money this year. I'll open up a Wealthsimple RSP account, and I'm going to throw all my RSP into passive investing ETFs. So I'm going to lean on you. So A, how does someone get into this? And B, how should I build up my portfolio? And we can cover this on this live here, or we can chat after. But I'm going to attempt the PII for the next, forever, but kind of allot my RSP contribution this year. So
the first tip I would give you is, first you need to understand the strategy, because it's pretty much a contrarian strategy to the mainstream growth strategy. It's really, these types of products are really they're designed to buy and hold long term. They are not designed for growth. So a lot of people, they just have that tunnel vision, the stock price, if it's not going up, it's not growing. It's actually not true. If you have a fund or an ETF that gives you a 10% yield, which is very achievable now with all these great covered call funds that we have, even if it never grows, it stays the same stock price for the next 5 years, your annual return is 10% a year. Yeah. Which is pretty much beating the overall Canadian market, which does typically 7 to 8. Mm-hmm. So the first thing you need to remember is that this is it's an income-oriented product. It's not a growth-oriented product, which means you have more flexibility because you could just drip it. If you drip it, you're literally turning it into a growth style, but you're growing not with the share price, although it can grow with the share price, you're growing with compound interest. So you have to understand, first of all, how this strategy works, and you have to be comfortable with it. Obviously, you should understand, how covered calls work. It's nothing abstract. You're still investing in the stocks in that portfolio. So it's always important to go on the fund's website, look at the stocks inside the ETF. Tesla one was easy. That's more of a high risk one because it's Tesla stock. That's what you're really investing in. So go on the ETF's website, look at the stocks you're investing in, and 99% of the time, they're big, boring blue chip stocks that you'll recognize. You're just getting it in an income form instead of a growth form. That's number one. Another tip I would give people starting: go broad, don't go niche. So there's a lot of niche covered call ETFs, just like there's niche growth ETFs, right? Like only lithium or green energy or this and that.
Tens of thousands of them out there. Yeah.
There's thousands of them out there, whatever the new flavor of the month. I tend to stay away from those, and the same goes for the income style. So there's many all-in-one covered call ETFs now. There's 4 of them in Canada, very, very popular, where they're extremely well diversified. They pretty much try to follow like the TSX 60 or the S&P 500. There's actually index-based covered call ETFs where you could buy the TSX 60 and they do covered calls. Buy the S&P 500 with covered calls. So that's the second tip I would give you. Go broad. Don't go niche.
Okay. So what I'm going to do is I'm going to throw my stuff into, and then I'll keep our viewers up to date on how it's going and share that. I don't share my portfolios. I keep that stuff pretty private, but this one I thought would be a fun experiment. I know we have a lot of overlap in viewers, and I know a lot of PII viewers, like I said on your channel, they think financial advisors or planners are against the investment style or philosophy, and furthest thing from the truth. So
not the good ones, not the good ones. The bad ones are, because they don't make money that way. Right.
No, the bank won't let them sell their product. Yeah, exactly. So being independent on my side, I can do whatever I want. This is my money. So I'm going to give it a try. It'll help me learn and how the whole structure goes. And again, we have a lot of clients that do plans that have this style. So we'll touch base after this video, and we'll get a portfolio put together. And then I'll keep the portfolio update going on this channel, and people can kind of follow along and learn what this whole channel, your channel, my channel, it's all about education and helping Canadians out, or people beyond Canada as well.
I mean, I unveil my portfolio every single month.
Yeah,
it's a staple. It's my most popular video, most viewed video by far. That's when my channel started gaining momentum. So you know what, I have no taboos about money. I don't mind sharing it. I think we should all share, and so we could actually learn.
Totally.
So all the investments I typically talk about on my channel, I own myself, and I update my portfolio on a monthly basis.
Yeah, that's awesome. Just to wrap up, tell us a bit about kind of like your services, kind of how you can help out some of our viewers if they're looking to get into the PII stuff, and how you kind of can. Yeah,
I have a channel called Passive Income Investing. Like I said, I unveil my 2 most popular monthly series videos is where I unveil my entire portfolio. So I typically always talk about the funds and things like that. Then I also have my picks of the month, where every month I review the top or most popular high yield, covered call ETFs on both the Canadian and US market. I actually cover both markets because there's great income oriented products on the US market as well. And I just review them, what's going on, any updates, anything new. And I do other videos where I interview fund managers who are actually managing these products, and if there's a new product. So that's obviously the best resource, and and it's all free, of course. In terms of products and services, I do have a digital product which is called the Ultimate DIY Investing Package. It's just a list of ETFs, closed-end funds, split share fund on both the Canadian and US markets, as well as sample portfolios for all your styles of investing. There's growth, there's dividend, there's income. I say all the time, a lot of people think, I'm against the growth strategy or the dividend strategy. No, I think growth, dividend, and income all work well long-term. So the product is, I like to describe it as a reference guide or a companion tool to maybe help you build your portfolio. It's not that expensive. You only got to buy it once, because I update it once a year. So it comes with lifetime updates. And besides that, I offer a one-on-one coaching service on my website where you could have an hour with me and we could discuss, and you could ask me whatever you want. So in case you're getting started or you're transitioning, I offer that service as well.
And I know a lot of our viewers have taken advantage of that and have great feedback. So if you're looking
that's how I discovered you.
Yeah, exactly. Yeah, that's how we got connected.
Like, Adam? We were also with him, and he helped us with our retirement and everything. I'm like, I'll check it out. So it's good stuff. It's all about educating, like you said. I'm not trying to push my investing style on anyone. I'm just showing people how I invest. It's really up to you to make the next steps. If it's really a good style for you. And you could take a hybrid approach also, right? You could do, I have a lot of my viewers do kind of a half dividend, half income, or half growth, half income, or 33, 33, 33. There's no shortage of options. Investing is very subjective. It's all about finding the best style for you.
Absolutely. Yeah. Well, hey, Adrian, thanks so much for joining us. Again, we'll link your channel below if you're not already checking it out. I know there's a lot of overlap in viewers, but if you haven't checked out Adrian's channel, make sure to do that. Great content on there. So again, thanks so much for joining us, and we'll see you guys in the next one.